Welcome to the Explainer, everyone. I am literally so excited to get into this today. We are breaking down what is, without a doubt, the biggest IPO in the history of capital markets, SpaceX. But look, we aren't just going to sit here and read flashy headlines, right? We're taking a structured journey through the actual data, stuff straight from the financial prospectuses, the market day traders, the expert analysts, and of course the company itself. So let's cut through all the noise and look at the actual mechanics of this absolute monster of an event. To really wrap our heads around where we are today, we gotta look at how this whole thing started. At the Nasdaq debut, standing there in front of thousands of people, Elon Musk admitted something pretty incredible. He said he originally gave SpaceX less than a 10% chance of success. Like, he literally told people, we probably will fail, but we just have to try to make humanity a spacefaring civilization. Now, contrast those early doubts with the historic $1.77 trillion valuation it launched with. No way, right? It's just absolutely mind-blowing. Okay, let's dive into this. Here is our roadmap for the Explainer today. 1. The historic SpaceX IPO. 2. Riding the initial momentum. 3. The float and valuation risks. And 4. Investing strategies to consider. All right, Section 1. The historic SpaceX IPO. So during the opening remarks, SpaceX President Gwynne Shotwell did this beautiful job of summarizing the milestones that totally silenced the haters. I mean, people said they'd never reach orbit. Well, they did it in 2008. They said they couldn't build a real rocket. They launched Falcon 9 in 2010. They were told there's no way they'd reach the space station or, land and reuse rockets. But they hit every single one of those milestones. And when you add in their recent acquisition of xAI, which gives them gigawatt-class computing power, it just perfectly set the foundation for this historic 2026 public offering. And when I say historic, I mean the numbers are just staggering. The IPO raised a monumental $75 billion in capital. But here's what's even more incredible about the belief inside this company. Out of their roughly 22,000 employees, more than half of them actually bought more shares at the open. We're talking nearly $1 billion injected from the employees alone. All of this culminated in massive day-one market cap estimates of roughly $2.1 trillion. To put that into perspective, it is priced for absolute perfection. They're factoring in satellite internet dominance, commercial space travel, Mars colonization, the whole shebang with AI integration. And really, that sets the stage for exactly why the market reacted with such explosive, unbridled enthusiasm. Which brings us to Section 2, riding the initial momentum. On the very first trade, Bloomberg reported an immediate 11% gain. And the day trading environment, well, as captured by networks like Trader TV Live, it was basically absolute chaos. We saw heavy retail momentum pushing the stock ticker SPCX well past $188 a share amid just massive, intense FOMO. Honestly, the hype was so wild that Matthew Tuttle of Tuttle Capital Management immediately launched a 2x leveraged SpaceX ETF trading under SPCK for anyone looking to literally double down on the daily momentum. Now, what's really interesting about this slide is the reality behind all that hype. When we actually crack open the prospectus and look at the 2025 estimates, we see $18.7 billion in revenue. But look a little closer here. Starlink is basically carrying the company right now with an incredibly healthy 39% operating profit margin. However, the overall net income, that's sitting at a negative $4.9 billion. Those heavy operating losses are really being driven by their massive investments into space exploration and xAI. Let's pivot to Section 3, the float and valuation risks. And this brilliantly illustrates the biggest structural risk of all. Retail investors who are out there fighting over shares, they're currently bidding on just a tiny 4% sliver of the entire company. A massive 96% of the shares are currently locked up. It's like everyone fighting over a single slice while the rest of the pie is hidden away. So a lockup period is basically a legal restriction preventing early investors, venture funds, and company insiders from selling their shares immediately after an IPO. It's designed to stop the market from being instantly flooded. So that massive 96% chunk of SpaceX is kept completely off the market right now, which naturally artificially squeezes the supply and pumps up the current price. But as you might guess, that dam will eventually break. While the IPO launched in June with just that 4% supply, the very first lockup expiration hits in August 2026. This unlock continues rolling through September, and by October 2026, roughly $1.7 trillion worth of previously restricted shares will suddenly be available on the open market. The supply is going to drastically increase. This exact timeline has sparked a massive debate among financial analysts. The bear case, argued by folks like Bob Sharp, warns that this flood of supply from early investors cashing out is going to put massive selling pressure on the stock, potentially crashing the price. On the flip side, the bull case, coming from Fundstrat's Tom Lee, argues that, hey, SpaceX isn't actually fully funded yet. They absolutely must maintain a good relationship with the public markets to access capital over the next 5 years, so they're going to tightly manage that share release to make sure a crash doesn't happen. Aside from the whole float debate, there's another totally unique factor here: single founder dependency risk. Analysts point out that Elon Musk is heavily split between his massive ventures. Actually, we've seen this play out in the past, right? How shifts in his attention, like focusing heavily on social media or Dogecoin, have impacted the stock performance of his other companies. For a company so heavily reliant on one guy's vision and government relationships, that split focus is a very real valuation risk. Moving on to Section 4, Investing Strategies to Consider. So what does all this data actually mean for you? Well, it really boils down to two distinct approaches: direct versus passive investing. Buying the stock directly right now means you are paying a massive hype premium and dealing with that dangerous float squeeze we literally just talked about. Alternatively, passive indexing allows you to automatically own SpaceX as it gets added to major index funds. You're letting the system do the work for you without facing all that immediate crazy volatility. So the crucial point is exactly how that passive math works. Let's break it down. If you hold a total market fund like VTI, it naturally adds SpaceX in about 5 trading days, giving you roughly $110 of exposure for every 100K invested. If you hold the QQQ, it gets added in about 15 days, which gives you roughly $680 of exposure per 100K. But if you hold S&P 500 funds like SPY, you won't even see it until mid-2027 or later. The beauty here is that by just folding these funds, you automatically become an owner of SpaceX without paying that day one hype tax. And avoiding that day one hype tax, historically, that is a very smart move. Decades of academic research from experts like Jay Ritter show that IPOs actually underperform small cap indexes 4 out of 5 times. They usually lag the market by about 2 to 3% annually. Just look at past retail darlings like Robinhood, which totally plummeted after its initial hype. Even Saudi Aramco, the previous record holder for the largest IPO, is still down 13% from its offer price. History kind of proves that retail investors buying the day one hype often end up holding the bag. Let's move to and see how this builds into a practical, balanced strategy. Step 1, exercise patience. Just wait out this initial hype and those massive lockup expirations coming in August. Step 2, keep an eye on macroeconomic factors. As analysts noted, things like unexpected Bank of Japan rate hikes or domestic Fed decisions can flip broader market sentiment in a heartbeat. And step 3, simply let the market determine the company's true fair value over time based on its actual math, not just its story. I really want to leave you with this incredibly grounding quote from analyst Bob Sharp regarding the SpaceX debut. "The number on the screen today is very loud. The data is quiet, and I'll take quiet every time." I love that. It perfectly captures the contrast between the crazy spectacle of day traders screaming about momentum and the calculated, steady discipline required for real long-term financial success. Ultimately, there is one question you have to ask yourself after reviewing all of this today. Are you speculating on the hype of the greatest IPO in history, or are you actually investing based on the quiet, steady math? Evaluate your risk tolerance, look at the underlying data we walked through today, and make the choice that builds your future. Thanks for joining me on this explainer, and I will see you on the next one.